Hey guys, today we're here with,
Gina Milloway, Certainty Home Loans.
and I'm Toby Russell. I'm a realtor here in North Carolina, cover the Triad area. If you're moving to North Carolina, I'd love to hear from you. Today we're talking about the top 5 things that affect the interest rates you might get on your home loan.
So, Toby, I think most people don't realize that there are actually different things that go into determining your personal mortgage rate.
Right, because everybody thinks they'll get their neighbor's rate, which is at 2.9 or something.
Exactly. Or that you're going to get that 0% interest rate mortgage because the Fed's cut rates to 0. And that is definitely not the case.
FYI, if your realtor told you they were 0%, get a different realtor.
Yes, absolutely. Toby will be absolutely helpful. So, number 5 is length of loan term. And loan term is how long is your mortgage. So how this affects the interest rate is a 15-year mortgage is considered less riskier than a 30-year mortgage. There's less time to pay it back, less time that the bank has to have the money out there. So it gets better pricing because it's a less risky loan.
So this is the same whether it's a fixed or an adjustable rate?
There are actually some differences between fixed and adjustable rates. So an adjustable rate mortgage is typically a 30-year term. And the difference between a fixed rate mortgage and an adjustable rate mortgage is that the adjustable rate mortgage is fixed for a certain period of time, and then after that time is up, the interest rate starts adjusting. So typically on an ARM or an adjustable rate mortgage, the interest rate will be lower during the first fixed period. This fixed period can be either 5-year, 7-year, or 10-year, depending on the loan product. So a lot of times you'll hear the term 5-1, 7-1, or 10-1. That means you have 5 years of fixed, and then every year after that, the loan starts adjusting. So in the beginning, this does have a lower interest rate. I like to use this product for somebody who's maybe moving to town for a job, wants to buy a home, take advantage of the market, and then sell or refinance in the first 5 years.
Yeah, I'll suggest them for somebody to, if they just need to get in the house and get to that sweet spot payment that they're wanting, and that's just enough to get them there, then it'll get you there for 5 years, and then refinance and you're good. I didn't realize that the other day until I heard you talking about it, that it was a 5-1. I've heard 5-year ARM, but I thought it was every 5 years it adjusted. I didn't know it was every 5 years and then every year after that.
But the first two numbers, the 5 and the 1. So the first number is the length of time that the mortgage is fixed. The number after that is how often that rate will adjust. So on a 5-1, you have a fixed 5-year period, and then at year 1, your rate starts adjusting. There are 5-2s, there are 7-1s, 10-2s. There are a various amount of products out there, but that's what those numbers mean.
Gotcha. Cool. Now number 4 is, are you buying points on the loan? We've talked about this in real estate school, but most time it doesn't really have to do with us. It's more the mortgage people.
Yeah, and honestly, there's really a lot of confusion around points and what does points mean. So I get a lot of people who go online and shop rates. And typically the online lenders will advertise a really, really, really super low rate. Like if your average rate's around 3.5, your online lender's gonna come back and say, we can get you 2.5. No, there's a cost associated with that. They are adding points to the loan. Now, let's say somebody wants a lower interest rate. They can pay more money up front at closing and buy their rate down. You can buy a lower interest rate. So let's say the rate's at 3.5, but you want a 3. Typically what I'll do is I'll sit down and compare the cost of the rate versus how much is it going to save you in interest over the life of the loan. If you have a 30-year mortgage, it could be a substantial amount with very little money up front to buy the rate down. Buying your rate down too is also a way to get into more house. The lower the interest rate, the lower your overall payment. So more house you can afford, especially right now with inventory as low as it is. It might be worth your while to at least consider it. It's not a bad thing at all.
So basically points are just prepayment of interest ahead of time to get that lower rate for the long term.
Exactly.
Gotcha. And number 3 is the loan to value of the house you're looking at buying.
So loan to value can affect your interest rate. And let's say, for instance, if you are putting 20% down on your loan, the bank considers this a less risky loan than putting 5% down or 10% down, and they are going to give you a more favorable interest rate for this.
Because you have so-called skin in the game.
Yeah, you have a little more skin in the game. The bank has a little more equity already built into the home, so it is a less riskier loan. And let's say, for instance, something happened to the home and it foreclosed and the bank had to sell it to make up the difference, then they're more likely to get their money out of the sale versus if you had put 5% down or did 100% financing. So yes, you will definitely get a better rate with having a little bit of equity in the home. So number 2 is the type of property that you are buying. And a single family residence or your primary home will get you the best rate. And other types of properties are going to be, for instance, like a mobile home. That will have a higher interest rate associated with it. A second home will have a little bit higher interest rate on it. An investment property is going to be the most expensive loan that you can get. This is considered the riskiest loan out there. This is going to require the highest down payment, and especially right now, even with COVID, we're having a hard time getting loans for investment properties. So you're going to need a higher down payment and you're going to have a higher rate when buying an investment property. How this is risky, let's say, for instance, you own a single family residence, your primary home, and you own a second home and you own an investment property. Typically, the history is if somebody goes into bankruptcy or foreclosure, the investment home is the first one to go, then the second home or vacation home, and most people try to hold on to their primary residence as much as possible. So in that order, the level of riskiness, so that's going to affect the interest rate.
Home loan would be the least risky because people need somewhere to live, obviously.
Right, exactly.
And the number one reason why you may not get the same rate as your neighbor down the street is your credit score.
Yes, the credit score plays a huge part in your rate. Typically, anybody with a 740 or above is going to get the best rate and the best options for loan products. They're going to have pretty much almost any loan available to them 740 or over. The opposite of that is 620 and below. So 620 and below is going to get the worst pricing level. And 580 and below, if you can find a loan right now under 580, that is going to be the worst available rate that you can get. So right now we're dealing with COVID and there's a lot of overlays on loans. Lenders are tightening their guidelines. Most lenders have raised their minimum credit score to 620 right now. So 620 and up is really where we're looking at for loans that are out there.
Used to, I would have to shoot for 580, and sometimes it's hard to find people that have 580. And now I've got to shoot even higher, hoping for people that can get 620.
Yeah, I think right now in North Carolina, the average credit score is right around 660.
Now, for those of you that may not quite have the credit where they need to be, I think you can kind of point them in certain directions to help them improve their credit, correct?
Yeah, absolutely. So my disclaimer is I'm not a credit repair specialist, but I can look at your credit and I actually have a little system that I can run that shows me some quick tips on getting that credit score up. So it really depends on the complexity of what's on the credit score. If there's a few minor things like paying down a credit card, then yes, we can definitely work on that. And that's actually one of the biggest things to increase your credit score is paying down on credit cards.
All right, guys, I hope you enjoyed that and learned something about the top 5 things that can affect your mortgage and why you may not get the same as Bob down the street. And if you've got any questions about mortgages or anything else in North Carolina, please give Gina a call at
336-602-7034.
And like always, tune in next week. We'll have another video. My name's Toby Russell, realtor here in North Carolina, and I look forward to helping you.
Thanks.
Thank you and have a great day.